Let's talk about GameStop. A surge in GameStop shares then by retail investors rocked Wall Street over the last month, prompting lawmakers to request a hearing, while Treasury Secretary Janet Yellen held talks with market regulators. But despite the turmoil, research from JP Morgan shows GameStop was not in the top 10 most bought names by retail investors in January. David Waddell joins us, the CEO and Chief Investment Strategist of Waddell and Associates. David, just bring us up to speed for a moment here, because I know you've been looking very closely at this story ahead of us coming to you for this conversation. The action around GameStop seems to be a lot less frenzied than it was a week or so ago. What has happened to those retail traders?
They moved on. I think the cryptocurrencies got a bid soon after that. The meme stocks themselves were always just going to be sort of a moment in time. And again, the market cap on those is pretty low. If you consider the size of the market overall is 50 trillion, and those stocks at their highs were sort of 20 billion-ish. And so the frenzy that surrounded those stocks, which is interesting now to read about the institutional involvement, was a combination maybe of the retailers broadcasting it, but the institutionals playing behind the scenes. So there was plenty of traffic, retail and institutional alike, and I think the story dies down. But the Reddit chat room is 9 million people at this point. So if they've got 10 grand a piece, that's $90 billion that can shoot at stuff. That's a lot of money and can move things around. But they've got to be lower liquidity sort of issues than the big stocks that move the S&P.
You know what, we've been doing this, all of us, a very long time, and we've seen a lot of trends come and go in markets. I'm loath to say that this indicates a significant structural change, but maybe I'm wrong. Is it different this time? Does this represent a new way for retail investors to access the market and stick it to the hedge funds?
I don't think so, not really. And hedge funds stick it to themselves all the time. The survivor rate in hedge fund land isn't very strong. So the assumption is that they're all sort of omnipotent masters of the universe, but they make mistakes all the time. So the retail investors played the game. A lot of them lost money. But this is reminiscent of what we saw in the late 90s when you had a lot of retail activity. You had margin levels rising. You had people trading stocks up 50% just because the companies added a .com to their name. So we've seen this before. And by the way, it's just indicative of excesses that are coming from this sort of COVID stimulus craze. We have 30% more money in the U.S. than we had this time last year, and 30% more money means 30% more of everything, including sort of retail trading activity. So I think it ends up, flaming out a little bit, but that'll depend on how long these stimulus waves roll.
David, it seems very hard to regulate. I mean, freedom of speech is one thing on social media. You can't take away from the ability of people to post what they like. But that said, to manipulate a market based on posts on social media is another thing. At what point do the regulators find a way around what they're witnessing?
They won't. Because they have to make a decision on whether the merits of a trade are speculative or fundamental. And there are 3,000 stocks that they'd have to make that decision upon, and they're just not going to be able to do that. So there'll be some photo ops and there'll be some hearings, but I can't imagine anything comes from it. I mean, we already have an uptick rule. There's a 2-day settlement that could be under review because that requires the broker-dealers to have a lot more capital, and that's what led to Robinhood having to shut things down for a little bit. So there might be some structural changes there, but I don't think they can regulate the difference between speculative and fundamental investor interest.
David, I'm a great believer in the securities lending industry, and I'm a great believer in the ability of short sellers to actually seek out more realistic valuations for a lot of overly pumped up stocks. That said, it's become a very dangerous hobby at the moment, shorting, and with people looking at short interesting stocks as well, gunning for those shorts as well. Is it going to change the way that industry operates?
Yeah, I mean, one of the hedge funds that was involved already declared that they're not going to do shorts anymore. And certainly those who have shorts are going to be a little bit more cautious about cloaking their positions. People never really make money off the short side of the book. They use that to lever up the long side of the book, and it tends to work. So pure short sellers are not a big part of the marketplace, and the short selling volume while it was high, is actually low overall. So I think the shorts are a curiosity within the market, and they're curious and interesting, but I just don't think it's a big enough part of the market to really matter.
Yeah, what about the hypocrisy from the institutions that actually own the stocks as well? Is that rearing its head yet again? Because every time I always hear about the activities of the shorts, I hear the institutions bemoaning their activity, but they're the ones who are actually lending the stock in the first place.
Yeah, and that's how Robinhood makes money, right? So, yeah, I agree. There's plenty of hypocrisy, and everybody talks their books, and there's tons of misinformation. And so the lesson of all of this is if your trading time horizon is really 3 days, 3 weeks, or 3 months, the market's just going to whip you all over the place. The real opportunity for somebody like us as long-term investors is when hedge funds have to puke shares and the stock market goes down because of technical factors, with fundamentals the best I've kind of ever seen them, then it just creates an arbitrage opportunity between long-term investors and short-term investors. We took advantage of that and put a lot of money to work. So the crazier that they get, the bigger the opportunities are for long-term investors to take advantage of short-term investors, and that's what we did. So this isn't new on Wall Street. It's just that the broadcast signal is so much higher with social media, I think.
David, are you really in Memphis at this time? It's 2 o'clock in the morning, sir. What on earth are you doing?
Well, I'm just such a big fan of your show. The invitation was irresistible, so happy to be with you. But it meant that I couldn't drink beer for the Super Bowl, so I'm a little irritated by that.
Yeah, I bet you are. Well, you're a star, and if we had any mugs to send you, we would, or something, or another gift from the show. But thank you very much indeed for that. David Waddell, who's the CEO and Chief Investment Strategist at Waddell & Associates. Good to see you, sir.